15 of 21 series are aligned with an acceleration configuration this morning. That is a moderate level of systematic agreement across the engine's macro map. The current macro regime is acceleration, with a confirmation score of 15 out of 21. In the framework, the acceleration macro regime means the growth composite is strengthening while the inflation composite is also firming. Growth momentum is measured as an acceleration of about plus 0.01 relative to its recent trend, a small but persistent uptick that the math treats as broad-based improvement across coincident activity indicators. Inflation momentum is accelerating at roughly plus 0.00 on the framework's normalized scale, reflecting a mild but noticeable build in price pressure signals, including commodities and core consumer prices. The coherence score today is weak, even with a confirmation score at 15, which tells us the alignment is present, but not tightly clustered across all 21 series. Historically, by the engine's reckoning of comparable conditions, regimes with this level of confirmation score have persisted around 47% of the time over 3-month spans when reached from similar starting points. Compared to last week, confirmation is relatively stable in the mid-teens range, while the most notable change came from the Chicago-based activity index softening, tempering the growth side of the picture. In past environments that the engine has labeled acceleration, markets have often felt like they were trading under the tension of firmer commodities, upward pressure on rates, and a debate over how long stronger nominal data could coexist with rising volatility. A record of past behavior in the data, not a guide to future moves. Let's walk through 4 signals the engine is watching under this backdrop, using plain language and focusing on why they matter. First, the U.S. Treasury yield curve, particularly the 10-year note, sits near 4.65%, with the curve modestly positive between the 2-year at about 4.31% and the 30-year near 5.12%. That places the 10-year within a normal range, but the bond volatility gauge shows a mild uptick in rate movement. In the framework, the yield signal is currently coded as yellow momentum, neither strongly favorable nor strongly unfavorable, with changes in yields clustered within a narrow band, but skewed slightly higher. Markets watch this because the 10-year rate is one of the simplest real-time reads on how investors are pricing growth, inflation, and policy risk together. The question this raises for allocators is whether a 4.5–4.7% 10-year changes how much duration or rate sensitivity they are comfortable carrying in portfolios. In our framework's reading of comparable periods, this roughly coincided with choppy bond total returns and continued rate repricing within 1 to 3 months, a record of past behavior, not a forecast. What would challenge this read is a decisive move lower in yields back toward 4.0% on the 10-year, or a sharp re-steepening of the curve driven by policy signals rather than data. Second, on the labor side, the non-farm payrolls and unemployment rate composites, while not updated in the past 24 hours, remain central to the regime map. With no fresh release overnight, the engine still carries its prior interpretation, an essentially balanced labor environment, where hiring growth is steady but not surging and the unemployment rate is low but no longer falling. The labor signal is marked green in the current configuration, meaning job market indicators are holding above their longer-term trend without showing clear deterioration. Labor data matter because they tell participants whether the economy has enough real activity momentum to support earnings without forcing the central bank into sharper policy moves. The question for risk takers is whether the existing labor strength supports their current equity and credit exposure, or whether they see signs that would make them reassess. In our framework's reading of comparable periods, this roughly coincided with historically stable credit default rates and relatively low recession flags over 3 to 6 month windows, an observation of past conditions, not a forecast. A clear challenge to that reading would be a step down in payroll growth or a sustained rise in jobless claims. Third, high-yield corporate credit spreads, the extra yield investors demand to hold below investment-grade bonds. are coated red in the engine's momentum layer. That label reflects unfavorable momentum, where spreads have widened relative to their prior month's levels beyond a thresholds the math treats as significant. Markets watch credit spreads closely because they are one of the cleanest real-time gauges of perceived default risk and overall financial stress. The central question this raises is whether widening spreads indicate a level of risk that changes how much credit or leverage an institution is comfortable maintaining. In our framework's reading of comparable periods, this roughly coincided with weaker price performance in lower quality bonds and a tilt toward higher quality debt within a 1 to 3 month horizon, a record of past behavior, not a forecast. What would challenge that interpretation is a meaningful tightening in spreads back toward their prior lows, especially if accompanied by improving earnings and fewer downgrades. Fourth, the equity sector configuration has shifted, with healthcare, financials, and materials showing relative strength, while technology and energy lagged in the latest session. Sector rotation in the engine is interpreted through a green-yellow-red lens based on relative performance and volatility. Right now, the technology sector carries a red momentum tag after a broad rout tied to AI and semiconductor names, while healthcare is green after a strong defensive lift, and financials and materials are leaning green to yellow as they push higher. Investors watch sector rotation because it offers a granular read on how capital is reallocating across growth, defensiveness, and cyclicality. The question this raises is whether the current sector balance aligns with each investor's view of macro risk and earnings durability. In our framework's reading of comparable periods, this roughly coincided with phases where leadership rotated toward more defensive and income-focused groups over weeks to months, a record of past behavior, not a forecast. A challenge to that read would be a renewed broad-based technology rebound accompanied by narrowing breadth in other sectors. Turning to the conditional map, the engine is tracking two specific if-then triggers. If the 10-year Treasury yield crosses 4.45% and holds that level for 5 consecutive sessions. In our framework's reading, acceleration in the inflation composite appeared in roughly 9 of 11 comparable conditions, a historical characterization, not a forecast. In regime terms, that kind of yield persistence has historically coincided with stronger mathematical evidence for transitions between milder growth configurations and firmer acceleration-type setups. If a broad fear and greed sentiment index drops below 15 and holds for 5 consecutive sessions, in our framework's reading, deterioration in the confirmation score, fewer series aligned with the prevailing regime, appeared in roughly 7 of 9 similar conditions. Again, a historical characterization, not a forecast. That combination has historically marked phases where risk appetite weakened enough to put the current regime under watch in the engine. The map is live. These conditions are being monitored daily across all 21 series. The Given engine is the automated rules-based engine inside Given Analytics. It does 2 things in parallel. First, it publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates we just covered. Second, it runs a fixed 4-layer mathematical framework: price structure, rate of change, risk regime, and market participation, across 407 liquid symbols every trading day. When all 4 layers agree on a symbol, the engine records it as an upside-aligned or downside-aligned condition under the framework, a reading of how the 4 layers line up, not a trade. These are time-stamped model readings, logged for members to study. The environment view and the condition log sit side by side inside the engine. They are separate outputs. The regime does not pick the symbols. The 4 layers do. Members use the engine to study how the framework has recorded conditions across prior environments, as historical behavior, not as trade selection. The Given engine runs the framework. You study the outputs and environment. You decide what to do next. This is May, potential educational context for understanding how the math has behaved, not for directing anyone's actions. The morning brief is the public surface. The live observation desk shows the full 21 series regime map, today's mathematical conditions across 407 symbols, and the historical archive side by side. Members study the environment and the engine's outputs each morning. If you want to track this alongside us, the live view is at givenanalytics.com. Free to try, no credit card for the first 500 founding members.